Iran just fired ballistic missiles at a city 13 kilometers from Israel's most secretive nuclear site, and Israel's air defenses failed to stop them. 150 people injured. A 5-year-old girl, a 12-year-old boy, and somewhere in a trading room right now, a single number, $112, is quietly becoming the most dangerous figure in the entire global economy. By the end of this video, you'll understand exactly why. On March 21st, 2026, Iran's Islamic Revolutionary Guard Corps launched a wave of ballistic missiles directly targeting the southern Israeli cities of Dimona and Arad. This wasn't a stray rocket. This was a calculated, named target strike, and it landed. Israel's layered air defense network, the same system that has intercepted hundreds of projectiles throughout this conflict, failed to stop at least 2 of those missiles. The Israeli military has formally opened an investigation. That detail alone should make you pause, because this is a country that has built its entire security doctrine around the idea that its skies are impenetrable. The reason those 2 cities matter more than any others in Israel is geography. Israel's Negev Nuclear Research Center, the country's most classified nuclear installation, sits just 10 kilometers outside Dimona. This was the closest any hostile missile has come to that facility in the entire course of this conflict. The IAEA moved quickly to confirm there was no structural damage to the Negev Center and no abnormal radiation levels detected. That confirmation came fast, which itself tells you how seriously the international community is watching this coordinates. Iran framed this entire operation as direct retaliation for a joint US-Israeli strike on Natanz, Iran's primary uranium enrichment complex. So we are now inside a confirmed cycle of strikes on nuclear-adjacent infrastructure between 2 nuclear-capable powers. Let that land for a second. But the nuclear close call was just the headline. The real story is what it means for markets, starting with oil. Let's talk about that number. $112.19. That's where Brent crude settled on Friday, the highest price recorded at any point since this war began. To understand how fast this escalated, go back to February 28th, the day this conflict formally erupted. Brent spiked 6.2% in a single session, briefly touching $82 a barrel. WTI surged 7.5%. Those were the panic numbers, the opening bell shock. The market hasn't calmed down since. It's climbed. Every week, every new escalation, every missile volley has added another layer of premium into the price. And now we're at $112. The mechanism driving all of it is one waterway, the Strait of Hormuz. This is a narrow choke point between Iran and the Arabian Peninsula, and roughly 1/5 of all global oil supply moves through it every single day. Jorge Leon, the head of geopolitical analysis at Rystad Energy, used the phrase effective halt of traffic to describe what's happening there right now. Not slowdown, not disruption, halt. When one of the world's most respected energy research firms uses language like that, you take it seriously. On Friday, President Trump publicly threatened to obliterate Iranian power plants if the strait wasn't fully reopened within 48 hours. That ultimatum is live as of this recording. And Allianz Research, one of the largest financial services firms on the planet, has published a formal warning that in a tail risk scenario, where Iran begins targeting Gulf energy infrastructure directly, Brent crude could exceed $130 a barrel. Goldman Sachs has gone further, suggesting elevated prices could persist not just for weeks, but straight through 22/7. But oil isn't the only thing burning. Gold just quietly crossed a number that most analysts said was years away. While every camera was pointing at the missile craters, gold crossed $5,300 an ounce, a new all-time record, and almost nobody led with that story. This is the classic wartime capital flight pattern, and it is playing out by the book. Investors who cannot stomach the volatility in equities are rotating into hard assets. Gold is the oldest safe haven there is, and when a nuclear facility in the Middle East narrowly avoids a direct missile strike, the rotation happens fast. The US dollar index simultaneously gained 0.95%, erasing every loss it had accumulated this year and hitting a 5-week high in a single session. 10-year Treasury yields briefly fell to 3.96%, their lowest reading since November, before reversing as the initial shock absorbed. JP Morgan, one of the most closely watched voices in global macro, has now formally revised its gold price target upward to $6,300 per ounce by December 2026. That is not a fringe prediction from a boutique shop. That is the house view of the largest bank in the United States. When JP Morgan sets a target 19% above where gold is trading right now, in the middle of an active conflict with nuclear undertones, the institutional money tends to follow. Gold is telling one story, defense stocks are telling an entirely different one, and it involves names you already know. Northrop Grumman, Lockheed Martin. When this war broke on February 28th, both names surged in pre-market trading before most retail investors had even read the headline. That is not coincidence, and it is not speculation. It is the market processing a very simple equation. More conflict means more hardware, more precision munitions, more stealth systems, more resupply contracts. U.S. Central Command has now confirmed striking over 8,000 military targets inside Iran. 8,000? That number represents an extraordinary consumption of precision weaponry. Every strike requires guidance systems, propulsion, targeting technology, and the industrial infrastructure to replenish it. The companies that build those systems are operating on a de facto war economy footing right now. The US has also deployed 3 additional amphibious assault ships and approximately 2,500 more Marines to the Middle East theater. That deployment doesn't just signal military intent, it signals procurement. Every deployed asset has a supply chain behind it. Every Marine needs equipment, logistics, and support contracts. For defense contractors, this is not a risk event, it is a revenue event. The uncomfortable truth is that while the rest of the market is pricing in fear, one sector is quietly repricing upward. Equities and defense are reacting predictably. But here's the market almost nobody is covering, and it may be the most important one right now. Here is what the mainstream coverage missed. While the financial press focused on oil and gold, the global aviation and maritime system quietly began to fracture, and the downstream damage is enormous. 7 countries simultaneously closed their airspace: Bahrain, Iraq, Israel, Kuwait, Qatar, Syria, and the UAE. Emirates suspended all operations. Etihad suspended all operations. Qatar Airways, the airline that connects the entire Asian subcontinent to Europe through the Gulf, suspended all operations. Over 4,000 flights were canceled per day at peak disruption. Air India, British Airways, Lufthansa, Cathay Pacific, and Virgin Atlantic all pulled Middle East routes. The passenger disruption is visible. The cargo disruption is invisible and far more dangerous to the global supply chain. Now move to the water. Iran imports roughly 30% of its own wheat through Persian Gulf harbor infrastructure. As of March 6th, 9 grain ships were physically stranded outside the Strait of Hormuz, unable to move. 9 ships. Allianz Research is now warning that global maritime freight rates are threatening to approach post-COVID highs. If that happens, the cost shock moves through every product that touches a shipping container, which is most things. The hidden losers in all of this are China and India. Both nations are massively exposed to Hormuz-routed oil, and both are watching their energy import costs detonate in real time. The US quietly granted India a 30-day emergency waiver on March 6th to purchase stranded Russian oil and stabilize domestic fuel prices. That is a geopolitical concession of significant magnitude, one that went almost entirely unreported. This supply chain crisis has a historical echo, and the last time we saw something like it, markets took 2 years to fully recover. To understand where this ends, you have to understand where it has been before. The closest historical parallel is October 1973, the Arab oil embargo. Here is what happened then. Arab members of OPEC cut oil exports to nations that supported Israel in the Yom Kippur War. Oil prices quadrupled in less than 6 months. The United States entered a period of stagflation that lasted nearly a decade. The S&P 500 lost roughly 45% of its value over the 2 years that followed. Gas lines stretched around city blocks. It reshaped American foreign policy, domestic energy infrastructure, and the entire concept of strategic petroleum reserves, all of which still exist today because of what happened in 1973. The critical difference now is that the US is far less domestically dependent on Middle Eastern oil than it was 50 years ago. The critical similarity is this: a choke point-driven supply shock with no realistic substitute route for the volume of oil at stake. There is no pipeline that replaces the Strait of Hormuz. There is no alternate lane for 20% of global oil supply. JP Morgan has formally stated that this conflict generates, in their words, greater macroeconomic risk than recent military conflicts, specifically because of its potential to fracture global energy and supply chain systems. Under a scenario where Brent holds at just $80 a barrel through mid-year, not 112, just 80, JP Morgan models a 0.6% annualized drag on global GDP and a more than 1% rise in global CPI. Brent is at $112. So what happens next? Here's what the analysts are actually watching. And one of these signals should make everyone nervous. 3 things. 3 signals. Watch these and you will know where this goes before the rest of the market does. First, the 48-hour Hormuz ultimatum, Trump's deadline to Iran over power plant strikes, expires imminently. If Iran blinks, you see oil pull back $10 to $15 overnight. If Iran escalates, or simply ignores it, which is what they have done with every previous ultimatum in this conflict, you see oil attempt $120 and the entire risk-off trade accelerates. This is the binary event that moves markets in the next 72 hours. Second, the air defense failure investigation. Iran's parliament speaker made a specific public statement after the Dimona strike. He said that Israel's inability to intercept missiles in the most heavily protected airspace in the country signals, quote, a new phase of the battle. If Israel's own investigation confirms a systemic failure rather than a one-time glitch, the regional risk premium that every asset class is trying to price doubles overnight. That changes gold. That changes oil. That changes every regional equity market, from London to Mumbai. Third, and this is the one that keeps macro analysts up at night, Goldman Sachs' 2027 timeline. Not weeks, not months. Through 2027, that is the scenario markets have not priced. Short-term oil spikes get absorbed. Structural, multi-year price elevation does not. It rewires inflation models, central bank policy, consumer spending, and corporate margin calculations across every industry that touches energy, which is every industry. That $112 barrel you heard about at the top of this video, Allianz says $130 is on the table if Gulf energy infrastructure gets targeted. Goldman says it stays elevated through 22/7. The question that nobody in any trading room or policy briefing can answer yet is simple. What's the number that breaks the global economy? And are we already past it? Iran just proved it can hit a city 13 kilometers from Israel's nuclear facility, and no defense system stopped it. So I'll ask you this. At what oil price does the rest of the world finally get pulled directly into this war? Drop your number below.